Hi everyone, welcome back to Kingdom Wealth Creators. Last time we talked about the why and how people should start investing in the stock market when they are in their 20s. We talked about how someone who's investing 500 rupees into the stock market when they are 20 would see a return of almost 2 crores when they're in their 60s. And that's an amazing fact that I think has really helped a lot of young people. In fact, there was a lot of good feedback on this video, and as a continuation, we want to today look at the question that most of them had, which is where do we do this investment? So today we're going to look at where can we make these investments when we are in our 20s. In case you haven't watched that video, please do watch that video here. Please do check out why and how you should start investing in your 20s before we get into the where we do our investment. Now, ideally, if you are in your 20s, you're either studying or you're working, right? There are some of us who are doing neither or sometimes even doing both. But ideally, you should be either studying or working. Now, if you're studying, that means probably you have a limited income or probably no income. You're probably depending on your parents or someone else. But even then, that doesn't mean you can't start investing. A small amount being invested even when you're studying would actually make a huge difference going forward, right? Secondly, if you're working, you definitely have some sort of an income flow coming in, and that means you should definitely be investing. Now, the biggest issue that young people have is they are thinking, let's make an investment and make a quick buck out of this in the next day or next month or so. But that is not the perspective that you should have. What you should be looking at is a long-term investment because you want to have a strong financial foundation for your future. Now, as mentioned in the previous video, first we should start investing into medical and life insurance. Just last week, as a family, we were going through a phase of viral fever, and my son had to be admitted into hospital for a couple of days. We got admitted into a private hospital, and the bill came to around 17,000 rupees. But because we had a good medical insurance policy, that was entirely covered. So you can see how that made a huge difference simply because we had medical insurance. So the first place you definitely need to invest is into medical and life insurance. If you are a person in your 20s or in your 30s or 40s and you're looking at investing say 500 to 1,000 rupees a month, there are two ways you can go about this. One is if you have the time and energy, you should definitely look at investing into stocks. Now, when it comes to stock market investments, we can either go investing into specific stocks or into index-linked mutual funds, like I mentioned in the previous video, right? Now, the thing about stock market is that you have to put a lot of research. So if you have the time and energy, you got to do your research and you got to figure out which are these good stocks that you can invest into. Now, the greatest satisfaction you can have in the stock market is when you do your research, and because of that research, you invest into something and you see it grow and you enjoy the fruit of that labor. That is the most satisfying part of the stock market. So if you have the time and energy, definitely look at specific stocks that you want to invest in. For me personally, this is an approach that I use. I look at some of the largest companies in some of the most important sectors that are contributing to India's growth, and that is where I would choose to invest. For example, companies that I invest into are Reliance, HDFC Bank, HDFC, ICICI Bank, Kotak Bank, Hero Motors, Bajaj Auto, Infosys, TCS, a few like these. Okay, basically some of the largest companies in India that are doing well and contributing to the growth of India's economy. Now, what I do here is basically I would look at when these specific stocks have fallen quite a bit. And that is when I would starting to make an entry into those specific stocks. Because eventually good companies will naturally grow, and because they naturally grow, their stock prices would also appreciate. So what I'm trying to do is to buy them when they are at a low point so that I can hold them for the long term because they're continuously going to grow anyway. But the entry point is important, when it goes down. So let me give you an example here. And one of the things that I use for this is something called ticker tape. And I will give you, so this is tickertape.in. By the way, I am not promoting tickertape.in. This is just the website that I use for this. So in tickertape.in, you can see you can go to something called the stock screener, and you can, what I do normally here is I would add a filter called 52-week high, percentage from 52-week high. And that's it. This is done for the most part. And also the stock universe, I would probably include Nifty 50 and Nifty 100. And that's about it. Now you can see here, for example, Reliance is the largest company on the NSE, and it is about 9% from its 52-week high. That's not a very good entry point as of now, right? But I scroll down the list, I see that HDFC Bank is at 30% from its 52-week high. I scroll down further, Infosys is 26% from its 52-week high. Go down further, HDFC, Housing Development Finance Corporation, is 40% from its 52-week high. Kotak Bank is 26%. So you can see there's a trend here. Most of these stocks, some of the best companies in India, are at about 25 to 40% from their 52-week high. And it is at about these times that I tend to make an entry into such stocks. Let me give you a specific example. If you look at HDFC Bank, I entered it at around 1350. HDFC, I entered it at around 2150, same levels as it is right now. And Infosys, I entered it at about 1580. So all of these are just stocks that are really good companies that I try to invest in when they are low, so that I can gain the fruit when they naturally will grow in the long term, right? Now, what happens if you don't have the time or energy to do your own research? Okay, simple. You have 500 to 1000 rupees a month that you want to invest, but you don't have the patience or the time or the energy to look at specific stocks. Answer for you is two things. Either you can choose something called the Nifty Bees. Now, if you look here on Zerodha, this is Nifty Bees, right? Nifty Bees is basically an ETF. An ETF is an exchange traded fund. Now, this ETF will basically mimic or replicate the movement in the Nifty 50 or the stock market. You can see here today that the Nifty Bees is at 177 or so. And this is when the market is at about 16,400. What happens when this went up to 18,500, when the stock market went to 18,600, the Nifty Bees had gone to about 210. So you can see there's a very consistent mimicking of the movement in the stock market by the Nifty Bees. And this is the easiest thing you can do. So if you have 500 rupees or 600 rupees or 1000 rupees, you can buy, say, 2 or 3 of these each month and accumulate them slowly, right? Now, for those who are very much interested in mutual funds, then we can go to Coin. Okay, Coin is the mutual fund application of Zerodha over here. By the way, I'm not promoting Zerodha either. It's just the platform that I use for my trading as well. So here is Coin. Coin is where you can invest into mutual funds off of Zerodha itself. Now, what I look for in a mutual fund is two things. One is I want the exit load to be 0%. I don't want it to be 0.25, I don't want it to be 0.5, I don't want it to be 1%, I want it to be 0%. And the expense ratio should be as small as possible, preferably below 0.5%. So if you go look for an index-linked mutual fund, you got to look for something that has Nifty in it, okay? Now, disclaimer here, there are a lot of Nifty funds. Some of them don't track the Nifty 50 itself. Sometimes they track the Nifty 150, sometimes they track something else. So you've got to be very careful. Now you've got to look at Nifty index fund, and also there are two types of funds available. One is a growth fund and the other one is a dividend fund. You can see here growth or IDCW. You always go for the growth fund. Now let's look at an example. This is the UTI Nifty index fund. If I click that, you will see that the minimum investment is 5,000 rupees. Okay, that's a big issue. The assets under management is quite good, okay, over 6,000 crores. The exit load is amazing, right? 0%. That's what we're looking for. And the expense ratio is 21%. But here's the problem. The minimum investment that you do at any point in time, either once short or once in a month or once in a week, has to be 5,000. So that's something that's going to be a little difficult for most of us, right? So then let's look for other Nifty 50 funds. Okay, okay, there's an HDFC Index Nifty 50 plan. Okay, so that is index linked mutual fund. So I click that. It's got a good, AUM 5,600 crores under management. But look at this. The exit load is 0.25%. The minimum investment is 5,000. Again, this does not fit our criteria. So I've actually gone through and searched for a few funds that meet our criteria, and I'm going to quickly show you which those are. Okay. So first one I looked up was something called the DSP Nifty 50 fund. Okay, so there's two of these. Nifty DSP equal Nifty 50 fund, which is growth, and there's the IDCW or the dividend payout fund. So you always choose the growth fund. So when I click that, you can see that here are some of the details about the DSP Nifty 50 fund. Right, the minimum investment is 500 rupees. Great. Exit load is 0%. Great. Expense ratio is kind of on the high side, 0.41%. The assets under management is 316 crores. Not a huge fund, but it's doing decently well. The exit load is good for us. The investment level is good for us, right? So this is something that you could probably look at. Another one that I researched and found was this Navi Nifty 50 Index Fund. Okay, now this is actually a very new fund. It just started this year. It's already got 276 crores under assets under management. Again, the minimum investment is only 500 rupees. The exit load is 0%, which is what we want. And the expense ratio is probably one of the best. It's showing 0.06%. Really good, right? Really cool. Now you can see from this graph of all of these funds, they actually mimic the movement of the stock market. You can see very clearly how when the market fell, the NAV of these funds also fall. So they are actually mimicking the market very accurately. Okay, so this is another one, but the best one that I saw, and I personally think is the one that I would invest into if I was investing into mutual funds, would be the ICICI Prudential Nifty Index Fund, because it's a growth fund. And I'll tell you why I think this is a good one. Okay, first of all, this has 2,900 crores under assets under management, which is very good, quite high. Not as high as the HDFC or the UTI ones that we saw, but the key point here is the exit load is 0%. The expense ratio is 0.18%, which is quite good. But the key thing I thought here was this minimum investment is 100 rupees. So for example, say I'm planning to invest 500 rupees a month, but I want to split it into 4 or 5 weeks, okay, or tranches of 100 rupees each week. I couldn't do that using the DSP or the Navi, but here I could do that. I can invest 100 rupees each week into this specific fund, and the exit load is 0%. The expense ratio is quite good, and the assets under management is much better than Navi or the DSP. And so probably out of all the mutual funds that are available that are index linked, these three are something that would fit my basket. So I hope this really helped you to understand where you can invest your 500 or 1,000 or even more per month investment when you are in your 20s, or even in your 30s or 40s, doesn't matter. But ideally, if you start investing in your 20s, this is where you can do your investment into the stock market. I encourage you to like this video, share it with all your friends and family. Please do subscribe to our channel if you're here for the very first time, and if really felt this content helps you. See you soon. Thank you so much.